Imagine a 40-degree summer afternoon in Delhi, NCR. You are hosting a dinner party and, you need fresh chicken and maybe some fish.
Always a stressful situation.
Right. And in roughly 95% of the country, getting that protein means physically walking into a local wet market, like a chaotic, loud, and let's be honest, somewhat visceral environment.
Yeah, it is definitely visceral. You are standing right there over a wooden butcher's block.
Exactly. You are watching the flies, feeling the heat, and verifying the cut of the meat with your own eyes before it just gets wrapped up in newspaper or plastic bag.
Which is a deeply, deeply ingrained ritual for millions of people.
It really is. So today we're looking at a company trying to convince those millions of people to completely abandon that ritual, to trade that visual trust for a cardboard box and a smartphone app.
And somehow make a profit doing it.
Yeah, that's the kicker. Welcome to today's deep dive. We are exploring the highly lucrative, operationally brutal transition of India's protein market, and we're viewing it entirely through the lens of a specific company. DSM Fresh Foods Limited, better known to you as Zappfresh.
It is arguably one of the most complex retail transitions happening globally right now. We have a really robust stack of sources today. Financial notes, company disclosures, and deep market analysis detailing Zappfresh's business model, their competitive landscape, and of course, their underlying financial health.
Okay, let's unpack this, because the stakes here are incredible. We are talking about an industry where the organized portion alone is worth tens of thousands of crores, yet the vast majority of transactions are still completely unorganized.
Yeah.
Zappfresh is actively trying to drag the Indian meat and seafood market into the formal digital temperature-controlled era. But as we'll see today, changing those centuries-old consumer habits while actually keeping the cash flowing is... it's an unforgiving business.
Unforgiving is the exact right word. I mean, if you look at standard retail, say formalizing apparel or books, the transition is mostly about warehousing and logistics. A t-shirt doesn't rot if the delivery truck gets stuck in traffic.
Right, a t-shirt is a t-shirt.
Exactly. But in the fresh meat sector, you are dealing with a product that actively degrades the second it is processed. You are operating in a climate notoriously hostile to cold storage, serving a consumer base that has very specific, localized expectations about how their food should look, smell, and cook.
Which means before we can even figure out if Zappfresh is actually winning this race, we have to understand exactly what they are putting in the delivery box and the cultural shift they are capitalizing on. So let's get into the meat of the matter. What is their actual product mix?
Based on management commentary, Zappfresh is an omnichannel, fresh meat and ready-to-cook non-veg retailer, and their product mix is heavily indexed toward daily staples. It breaks down to about 55% chicken, 21% mutton, and 24% fish and seafood.
See, that 24% fish and seafood figure jumps out immediately. Over half is chicken, which is standard. I mean, it's the primary driver of protein consumption in the Indian market.
Right, chicken is the baseline.
But a full quarter being fish. Seafood is notoriously fragile. It spoils faster than poultry. It's highly sensitive to temperature fluctuations, and the supply chain is incredibly fragmented.
What's fascinating here is how that specific product mix forces their hand on infrastructure. You cannot handle a 24% seafood volume without an absolute lock on your cold chain.
And you just can't fake that.
You really can't. And they aren't just selling these products to a family ordering dinner on an app. Their channel mix is split almost perfectly down the middle. For the first half of FY26, it was roughly 52% D2C, so direct-to-consumer via their app and website,
Okay.
and 48% B2B.
And when we say B2B here, we are primarily talking about HoReCa, like hotels, restaurants, cafes, and large institutional kitchens.
Yes, exactly. So they are fighting a two-front war. They have to execute flawlessly for the individual consumer who wants, 500 grams of boneless chicken breast on a Tuesday evening.
Right.
And they simultaneously have to satisfy the executive chef at a major hotel chain who demands 50 kilograms of standardized, highly specific cuts of mutton delivered at 6 a.m. sharp on a Friday.
Both of those fronts belong to a staggering total addressable market. The estimates for India's organized fresh meat, seafood, and value-added protein market put it roughly between 35,000 crore to 70,000 crore. The anchor point we are looking at is around 50,000 crore.
But that 50,000 crore only represents the organized sector.
Right.
The critical context here is that 95% of the total market is still unorganized. We're talking about local butchers, wet markets, and completely informal supply chains. So the growth opportunity isn't just natural market expansion, it's capturing share from that 95%.
But wait, getting people to transition from 95% unorganized to a formalized app model in meat isn't like convincing them to buy electronics online. I always think of it like the transition from buying loose, unpasteurized milk from a local vendor to buying branded cartons in a supermarket.
That's a really good analogy.
But if 95% of the country is used to buying from their local butcher, a guy they know by name who cuts the meat right in front of them so they can visually verify its freshness, how do you convince them to trust a sealed box from a warehouse they've never seen?
That is the central friction point of the entire business model. The local butcher offers visual transparency. You literally see the burr.
Yeah, you point to it.
Exactly. But what urban consumers are increasingly realizing, and this is driven by urbanization, dual-income households, and rising food safety awareness, is that visual transparency at the point of sale does not equal a hygienic supply chain.
Because you don't know what that chicken was fed, how it was transported, or, frankly, how often that wooden chopping block is actually sanitized.
Which is exactly the opposite of modern retail standards. The shift to organized retail is driven by consumers deciding they value institutional reliability over community familiarity. They are trading the sight of the butcher's knife for the assurance of a clean app interface, a vacuum-sealed package, and a guaranteed temperature-controlled journey from the farm to their kitchen.
But actually deliver that institutional reliability, you have to overcome perishability. You can't just put chicken on a shelf and fulfill it at your leisure.
If we connect this to the bigger picture of FMCG, think about why packaged snacks and dairy formalized so quickly. They are either shelf-stable for months, or, in the case of milk, like you mentioned, they have deeply established daily replenishment networks backed by heavy pasteurization.
Right, milk has a whole system built around it.
Exactly. Fresh meat requires a relentless, unbroken cold chain. It requires high-speed fulfillment and punishing operating discipline. Any temperature lapse doesn't just mean a late delivery. It means spoiled product, a ruined dinner, and an immediate, permanent loss of consumer trust.
Because if a customer gets a bad batch of chicken, they don't give you a second chance. They just walk back down to the wet market.
The switching cost is zero, and that dynamic creates an incredibly fierce battleground, which brings us to the competitive landscape, because a 50,000 crore formalization opportunity doesn't stay a secret for long.
No, definitely not.
Yeah.
So let's look at who Zappfresh is actually fighting. If the organized sector is only a 5% sliver of the total pie, it must be crowded.
Oh, it is intensely contested. You have Licious, which is widely recognized as the scaled national giant in the fresh meat and seafood space. You have Fresh to Home, which has a very strong specific positioning in seafood.
Right.
You have Tender Cuts bringing significant regional strength, particularly in the South. And then you have modern trade private labels, the branded counters inside large supermarkets.
So where does Zappfresh fit into that hierarchy? Because with 1 lakh plus app downloads, according to the company profiles, they aren't exactly going toe-to-toe with Licious on a national scale.
Zappfresh is a smaller, niche scaling player. They are heavily concentrated in Delhi NCR, though they're pushing into other select Tier 1 metros. Their 1 lakh app downloads represent a solid consumer presence, but it is modest compared to the national benchmarks.
The power dynamics here seem brutal for a challenger brand. You mentioned the customer has zero switching costs, which means consumer bargaining power is extremely high. If I don't like Zappfresh's prices today, I just open the Licious app or go to the supermarket.
The consumer holds immense power. And on the other side, supplier bargaining power is moderate to high and incredibly volatile. As a retailer, you are dealing with poultry farms, aquaculture setups, and slaughterhouses.
Right, actual livestock.
Yes. The supply of living animals is subject to weather events, disease outbreaks, feed cost inflation, and seasonal variations. You are squeezed between highly empowered, fickle consumers and volatile, perishable supply.
How does this competition change geographically? I mean, Delhi NCR is very different from a Tier 2 city.
Geography dictates the rules of engagement. In the top-tier metros, the competition is almost entirely about hygiene, brand trust, and delivery speed. A consumer in South Delhi or Gurgaon is willing to pay a premium for the guarantee that their chicken is chemical-free and hasn't been sitting in the summer heat.
Right.
But the moment you move into non-metros or even highly price-sensitive pockets within urban areas, Price becomes the sole determining factor.
And when price is king, the traditional wet market wins by default because they don't carry the overhead of cold chains, app development, and corporate marketing.
Exactly.
But let me push back on Zappfresh's positioning here. If Leash's is already the national benchmark, with vastly more funding and brand recall, isn't Zappfresh just fighting for the leftovers? I mean, how does a regional player survive when the national giants have bottomless capital for customer acquisition?
That assumes fresh meat operates like a software market where the winner takes all. It doesn't. Because the market is 95% fragmented, and because local supply chain density is the only thing that actually drives profitability, a regional player does not need national dominance to be successful.
You're saying moving physical perishable goods requires localized efficiency, not just national brand awareness.
Precisely. If Zappfresh executes a tight omnichannel strategy solely within Delhi NCR, like if they maximize the efficiency of their local processing hubs, saturate their delivery routes, and deeply integrate with local farmers, they can carve out a highly profitable territory. In the perishables business, local operational density often beats national sprawl.
Okay, so they don't need to conquer the whole country today, but to survive against the local butcher on one side and Licious on the other, they still need a serious competitive advantage. Let's evaluate their claimed moats. What makes Zappfresh special?
They base their competitive positioning on a few key pillars. First is brand trust. They lean heavily into the concept of clean protein, meaning hygienic, chemical-free, and preservative-free. Management claims this is working, citing roughly 90% monthly repeat orders and about 85% B2C retention.
Wow, those retention numbers are huge. If they hold up at scale, that implies customers are treating Zappfresh like a weekly grocery habit, not an occasional luxury purchase.
The second pillar is their distribution. They operate a farm-to-fork model, offering 90 to 120-minute delivery in their key metros, relying on strict cold chain logistics. They control the product from the sourcing stage right to the doorstep to minimize spoilage.
90 to 120 minutes is fast, but it's not quick commerce fast. It implies they are batching orders or utilizing a hub-and-spoke model rather than micro-fulfillment centers on every corner. What are the other pillars?
Cost advantage. Management claims their pricing is 10 to 15% lower than their immediate organized competition. And finally, they point to their technology. Internal operating systems designed for inventory management, demand forecasting, and end-to-end traceability.
Okay, let's unpack this, because claiming a moat in an investor presentation and actually possessing a durable competitive advantage are two very different things. How do these claims hold up to scrutiny?
We have to separate the credible claims from the unproven ones. The brand trust and the distribution network are highly credible. Building a localized cold chain that can reliably hit a 90 to 120-minute window without breaking temperature protocols is genuinely difficult.
Right.
And if they're actually seeing 85% retention, the brand trust is real.
But I am highly skeptical of the tech moat claim. Having an internal inventory system and demand forecasting software sounds like absolute table stakes for an e-commerce company in 2026.
Yeah, you would hope they have that.
Right. It's like a restaurant claiming their commercial oven is their competitive advantage. It's necessary to operate, but it doesn't protect you from rivals and the 10 to 15% cost advantage.
The cost advantage is highly unproven. Without fully audited gross margin data, detailed fulfillment cost breakdowns, or transparency into their yield loss, claiming a 10 to 15% price advantage doesn't mean they have a structural cost edge.
Let's talk about yield loss, because that is the hidden killer in this industry. When a consumer buys 500 grams of boneless chicken, they are just seeing the final product. But Zappfresh had to buy the whole bird.
This is a critical operational mechanism. When you procure a live bird or a whole fish, a significant percentage of that weight is bone, feathers, scales, and water weight. If your butchers aren't highly skilled, or if your processing equipment isn't perfectly calibrated, you lose sellable meat.
Oh, wow. So you're throwing away potential revenue.
Exactly. If Zappfresh is selling at a 10 to 15% discount, it might not be because they have magically solved yield loss. It could simply mean they are actively choosing to take lower margins or absorbing higher customer acquisition costs to win market share from Licious.
So they might just be subsidizing the customer's dinner with venture capital to look cheaper, which is a pricing strategy, not a structural moat.
The reality is that in the perishable food business, software and pricing discounts don't give you a moat. The real moat is the grueling, unglamorous daily execution. It's minimizing spoilage, managing that yield loss on the butcher's block, and ensuring the delivery rider's cooler bag is actually zipped shut in the July heat.
Right.
It's 100 small operational disciplines executed flawlessly every single day.
We've heard their claims, and we understand the operational grind required to actually pull this off. So let's look at the actual numbers. Show me the money. Do the financials reflect a thriving business successfully formalizing a messy market, or a struggling one trying to keep its head above water?
On the surface, the income statement looks like a huge success story. FY26 was incredibly strong. Revenue hit 221 crore, which is a 69% increase year over year.
Okay, that's solid.
EBITDA reached 31 crore, up 91% year over year, and their EBITDA margin improved to a very healthy 14.1%.
69% top-line growth and 91% bottom-line growth.
Yeah.
That clearly shows operating leverage. They aren't just selling more volume, they are absorbing their fixed costs better as they scale. The unit economics are visibly improving.
That is the headline narrative, yes. But you cannot evaluate a rapidly scaling retail business by only looking at the income statement. You have to look at the balance sheet, specifically their working capital, because there is severe strain showing up in the underlying mechanics of how they operate.
Okay, what kind of strain?
Their accounts receivable skyrocketed from 172.1 million to 553.11 million in just 2 quarters.
Wait, 172.1 million to over 553 million in 6 months?
Yes.
That is a colossal jump in money owed to the company. Where is that coming from?
It creates a huge disconnect in their cash flow. They reported a PAT of 14.4 crore in FY26. But if you shift your eyes to the cash flow statement for the last fiscal year, their operating cash flow was a negative 166.76 million.
Ouch.
Yeah. Their free cash flow was negative 207.5 million. And while they are burning this cash, their gross debt sits at roughly 455.0 million against a very modest cash buffer of somewhere between 24 million to 92 million, depending on the specific reporting date.
So what does this all mean? They're reporting 455.4 crore in profit on paper, but they're bleeding hundreds of millions of rupees in actual operational cash flow, and they're carrying 455.0 million in debt with barely enough cash on hand to cover a fraction of it.
It comes entirely back to that channel mix we discussed at the very beginning.
The B2B versus D2C thing.
Yes, remember the 52% D2C and 48% B2B split. The business is growing at 69%, and it is showing profitability on an accounting basis, but that growth is eating cash at an alarming rate. The jump in receivables is directly tied to their aggressive push into the B2B HoReCa segment.
Ah, of course. Because you can't ask a sprawling hotel chain to prepay by credit card in the app before you deliver 50 kilos of chicken.
Exactly. To win that institutional volume and drive that top-line revenue growth, Zappfresh is forced to extend credit terms to these B2B clients. They deliver the meat on a Friday, but standard industry terms mean they might not get paid for 30, 45, or even 60 days.
But Zappfresh still has to pay the poultry farmers, the delivery drivers, and the electricity bills for their cold storage right now.
Today.
Yeah, they're essentially acting as a bank for their B2B clients just to juice their own top-line revenue. At what point does extending credit to hotels stop being an aggressive growth strategy and start becoming a straight-up liquidity crisis? I mean, if a couple of major hotel clients default or simply delay payment by another month, Zappfresh's tiny cash buffer of 24 million to 92 million is going to evaporate against that 455.0 million debt load.
That is the existential tension hidden in their financials. The risk is that they are funding this widening working capital gap with external debt. If their collection cycle stretches any further, or if lenders suddenly decide they are over-leveraged and pull back, that growth engine stalls immediately.
Yeah.
It is a textbook case of a company growing so fast it risks running out of cash despite being profitable on the income statement.
This is a vital lesson for you as a listener. Whenever you are looking at a rapidly scaling company, never just look at the headline revenue growth. Never just stop at the reported profit. You have to follow the actual cash. If the cash isn't hitting the bank account, the profit is just a theoretical number on a spreadsheet.
And this cash burn reality completely forces management's hand. To fix that working capital strain, to service the 455.0 million in debt, and to justify their valuation, Zappfresh cannot just keep doing what they are currently doing. They have to keep growing, but they have to pivot into higher margin avenues that convert to cash instantly.
Which brings us to the road ahead. What are the actual growth levers Zappfresh can pull over the next 5 to 10 years to escape this B2B working capital trap and build a durable cash-generating business?
They have a highly specific playbook they are currently executing. The first and most critical lever is a heavy pivot into value-added products. They are actively moving beyond just selling raw, fresh meat and pushing deep into ready-to-cook and ready-to-eat categories.
Okay.
To accelerate this, they recently launched a frozen snacks venture called Miva Foods, and they acquired a company called Avium Food Tech.
I want to explore the mechanics of this because it fundamentally changes the nature of what they do. Why is moving from raw chicken breast to a pre-marinated chicken tikka or a frozen snack so structurally important for their survival?
Value-added products and frozen foods are the holy grail in this sector for three distinct reasons. First, they carry significantly higher realized pricing and gross margins. You are no longer acting as a commodity trader subject to daily poultry spot prices.
Right, you're selling a branded proprietary recipe.
Exactly. Second, frozen and heavily processed items drastically reduce the spoilage risk compared to fresh chilled meat, which immediately improves the bottom line by reducing waste.
That makes total sense.
And the third reason,
It improves basket sizes from existing customers without needing to spend a single rupee on acquiring new ones. If a customer is already buying fresh mutton for dinner, adding a box of frozen chicken nuggets for the kids is an easy upsell that costs Zappfresh zero additional marketing dollars.
it's exactly like a local coffee shop, realizing they barely break even on the standard black drip coffee, but they make all their actual profit on the flavored lattes and the pastries sitting in the glass case.
That's a perfect way to look at it. Zappfresh needs the raw, fresh meat to get you in the door, but they absolutely need you to buy the frozen snacks and the marinades to make the unit economics actually work.
The raw chicken is the customer acquisition tool. The ready-to-cook items are the profit engine.
But doesn't this strategy carry a brand identity risk? I mean, they built this entire brand on the promise of being the ultra-fresh, never-frozen, farm-to-fork, clean meat experts. If I open the Zappfresh app tomorrow and see frozen vegetarian snacks under the Miva Foods banner sitting right next to the fresh mutton, does that erode the core brand trust?
This raises an important question about brand architecture and capital allocation. It is a very real risk. If they blur the lines too much, they lose the premium positioning that allows them to compete against Lucius in the first place.
Right.
They have to manage these product lines distinctly to ensure the core fresh protein promise isn't cannibalized by the reality of convenience frozen products.
What's the second growth lever they are pulling?
Deep backward integration, specifically targeted at their seafood supply chain. They have identified a 40 crore annual revenue opportunity from aquaculture. This involves directly partnering with 1,200 individual fish farmers to procure 2,500 tons of fish annually.
1,200 individual farmers. The sheer logistics of coordinating that many independent aquaculture setups is staggering. But if fish is 24% of their sales, and we've established it's the most volatile, fastest spoiling product they carry, controlling the source is really the only way to guarantee quality and stabilize their input costs.
Exactly. It removes the middleman, drastically improves traceability, and secures a volatile supply chain.
And the third lever.
The third lever is geographic densification. Rather than spreading themselves thin across 50 different cities for the sake of vanity metrics, they are heavily focused on deepening their presence within Delhi NCR before pushing selectively into other Tier 1 metros.
Because, as we discussed, in perishables, local route density is everything. You want your delivery rider dropping off 5 orders in one apartment complex, not driving across the city for a single delivery.
Exactly. The math just doesn't work otherwise. And the final piece of their playbook is omnichannel expansion. They are moving away from being a purely app-only D2C brand. They recently ran a physical retail pilot with 15 to 20 local store partners, and they are now signing on 100 local store partners for the next phase.
So they want to meet the customer wherever they are, whether that's browsing on a phone or walking down the street to the neighborhood market.
Right, that's the goal.
So you look at all these levers, the high-margin, ready-to-cook products, the deep backward integration into 1,200 fish farmers, the route density in Delhi NCR, and the physical store partnerships. It's a very sound, aggressive strategy. But aggressive growth, launching new product lines, and carrying 455.0 million set in debt brings us to the ultimate question.
The risks.
Yeah. What can spoil the broth? What are the risks that could completely derail Zappfresh?
The risks are substantial, and they are inherent to the very nature of the model. The first is input cost volatility. They have extreme exposure to the daily spot prices of poultry and seafood. As we discussed, passing sudden inflation onto price-sensitive consumers is incredibly difficult and heavily delayed.
Right. If a feed shortage or a disease outbreak causes poultry prices to spike 20% overnight, Zappfresh can't just hike their app prices by 20% the next morning.
No, the consumer will instantly switch to the wet market or a competitor, so Zappfresh just has to absorb that cost to maintain market share, which instantly compresses their margins.
Oh, that else.
The second major risk is regulatory, specifically surrounding FSSAI, the Food Safety and Standards Authority of India. Operating a sprawling cold chain meat business means your entire brand equity is inextricably tied to hygiene compliance. FSSAI conducts audits, and a single documented failure in temperature control or a publicized non-compliance issue at one of their processing plants could destroy consumer trust overnight.
And in the meat category, brand destruction doesn't take months. It happens in a matter of hours. Once a consumer loses trust in the safety of your chicken, they are never coming back. What about risks at the corporate level?
This brings us to management and governance. The company has been led by its founder, Deepanshu Manchanda, since 2015. He clearly possesses deep, hard-won operational experience in this space. However, post-IPO, the promoter holding is surprisingly low, sitting at 28.1%.
Yeah.
Furthermore, the company relies heavily on an acquisition-led strategy, integrating roughly one new company every 1 to 3 years, like we saw with Avium Foodtech.
Why is a 28.1% promoter holding a red flag, or at least a yellow flag, for a company scaling this fast?
It is a double-edged sword. On one hand, it shows they were pragmatic enough to raise the necessary equity capital to fund their growth. But on the other hand, a low stake means the founder has less skin in the game relative to the total equity pool, and minority shareholders have far less of a buffer if things go wrong.
Especially with those acquisitions.
Right. When a company is aggressively acquiring other businesses to fuel growth, it requires intense, flawless integration. If an acquisition fails, if the corporate cultures clash, or if hidden liabilities emerge post-purchase, it severely drains operational focus and cash.
So when I look at the whole picture, the ballooning receivables from acting as a bank for B2B clients, the $455.0 million in debt against a tiny cash buffer, the extreme vulnerability to sudden poultry inflation, the constant threat of an FSSAI audit, and a highly complex acquisition strategy. They are essentially walking a tightrope.
They are?
If poultry prices spike during a bad quarter, or if a major hotel client defaults on that extended B2B credit, does the whole thing come crashing down?
I wouldn't call it a house of cards. They have real substantial revenue, they have built tangible physical infrastructure, and they sell a product that people demonstrably want and repeat buy. But, to your point, they are absolutely priced for perfection in an operationally unforgiving sector.
Right, there's no room for error.
Exactly. Their working capital situation means they do not have the balance sheet luxury to absorb a major strategic mistake or a prolonged macroeconomic shock. The execution across all fronts, from the butcher's block to the boardroom, has to be flawless, day in and day out.
It's an incredible balancing act, and it perfectly encapsulates the larger story of India's retail transition. It proves that formalizing a chaotic traditional market isn't just about building a sleek smartphone app. It's about mastering the gritty, physical reality of the product itself.
Which is why the transition is taking decades, not years.
So, to summarize our deep dives today, Zappfresh is successfully riding the colossal wave of India's shift toward formal, organized protein retail. They boast impressive top-line growth, hitting 221 crore in FY26.
Which is no small feat.
No, not at all. And they are executing a very smart, necessary pivot toward higher margin, ready-to-cook products while aggressively integrating their seafood supply chain. But they are balancing this rapid growth against severe working capital constraints, a concerning rise in receivables, driven by B2B credit, and fierce, unyielding competition from both the unorganized wet markets and well-funded heavyweights like Licious.
It is a logistical marvel when it works and a financial tightrope when it scales.
Next time you open an app and casually order some pre-marinated chicken or fresh fish for dinner, you'll know exactly what it takes behind the scenes. The relentless cold chain logistics, the hidden cash burn, the yield loss on the butcher's block, and the fierce battle for your trust just to get that dinner to your door safely.
It's a lot to think about before you start cooking.
It really is. And we've talked a lot today about the intense logistics of moving physical, perishable meat. But I want to leave you with a final thought to mull over. As alternative, lab-grown proteins inch closer and closer to commercial viability globally, the very nature of fresh meat might fundamentally change in the next few decades.
Oh, that's a wild thought.
Right. If meat no longer requires a slaughtered animal and can be cultivated closer to the consumer, Will the sprawling, highly specialized cold chain infrastructure that companies like Zappfresh are burning cash to build today become their greatest, most unassailable asset? Or will it become a heavily indebted relic of a bygone agricultural era? Something to chew on.
Indeed, it could redefine the entire formalization thesis.
The transition from the wet market to the app is still in its messy, lucrative infancy. We'll have to see where it leads. Thanks for joining us on this deep dive.